Let's start with the basics. What exactly are index funds? At their core, index funds are simply investment vehicles that allow you to buy a wide selection of stocks in one go. Instead of picking individual stocks, an index fund tracks an entire market index, like the S&P 500, which includes 500 of the largest companies in the US. So what makes them so popular? Low cost. Index funds are typically much cheaper than actively managed funds. The reason for this is simple. You don't need a team of managers picking stocks. The fund automatically mirrors the index's tracking, which reduces the cost significantly. Diversification. One of the biggest benefits of index funds is diversification. Instead of putting all your eggs in one basket, like betting everything on a single stock, you get exposure to a wide range of companies across various industries. This helps spread risk. So, for example, with an S&P 500 index fund, you're not only invested in tech companies like Apple and Microsoft, but also in consumer goods, healthcare, finance, and more. Simplicity. Index funds are a great option for anyone who doesn't want to spend hours researching individual stocks. Once you invest, you don't need to constantly monitor the market or make decisions about buying and selling individual companies. It's passive investing. Set it and forget it. But here's the catch. While index funds are incredibly attractive due to their simplicity, low fees, and broad market exposure, they do come with certain risks. And in 2025, with billions of dollars flowing into these funds, there are some important questions every investor should be asking. Now, many people assume that index funds are completely safe because they provide broad market exposure, but what happens when a market is top-heavy? In other words, what happens when a small number of companies start to dominate the entire market index? Visual. A chart shows the S&P 500 with a focus on the top companies, Apple, Microsoft, Amazon, etc., and how their increasing weight influences the entire index. Expanded explanation on concentration risk. Now, here's where things get interesting. As more and more money pours into these passive investments, a handful of companies can start to dominate the index. For instance, if you look at the S&P 500, the top companies like Apple, Microsoft, and Amazon have come to dominate a larger share of the index over the past decade. Together, they represent more than 40% of the total market capitalization of the index in 2025. So, as money flows into these index funds, it's essentially flowing into these big names first. While that can be great if you're invested in them, it also means you're increasingly exposed to the performance of a small number of companies. If something were to go wrong with one of those mega-cap stocks, it could drag down the entire index, even though the rest of the market is doing just fine. This phenomenon is called concentration risk, and it's something that many passive investors overlook. They assume that because the index fund offers a wide variety of stocks, their portfolio is automatically diversified. But if the biggest companies are so heavily weighted, your risk might actually be more concentrated than you think. Reinforcing the need for risk awareness. And this is critical, especially in 2025, when many experts are starting to warn that the sheer amount of money flooding into passive funds could create some unexpected market distortions. When we look at the growth of these funds, the automatic buying of large companies, because of their high market value, can end up inflating stock prices beyond their true value. The risk here is that investors start to rely too heavily on these big-name companies to drive the entire market forward, ignoring the long-term fundamentals of other companies or sectors. So, while index funds have traditionally been viewed as a safe bet, they still carry risks, especially in a market where the largest companies are making up an outsized portion of the index. Visual. Comparison of traditional diversification and top-heavy diversification with an animated visual of different-sized pie charts. Curiosity hook. But here's where things get really interesting. If the market goes through a correction or even a downturn, these top-heavy indexes could become a dangerous place to be. But how does this happen? And what can you do about it as an investor? Next steps. Diversifying beyond index funds. One thing to keep in mind. If you feel that the S&P 500 or any other major index fund is too concentrated in certain sectors or companies, it might be time to broaden your portfolio. Instead of just investing in broad indexes, you could explore options like value-focused ETFs or international funds that give you exposure to a more balanced portfolio. And for those of you who are looking for more control, Individual stock picking in sectors that you believe have strong long-term potential is always an option. Here's the key takeaway. Don't put all your eggs in one basket. It's crucial to stay aware of how much weight your investments carry in specific companies or sectors, and take steps to reduce concentration risks. Conclusion of Section 1. So, to sum up, index funds are a fantastic tool for those who want simple, diversified exposure to the market, but as we move into 2025, we need to be aware of their growing risks, especially with concentration. It's important to understand the potential downsides of these funds and to ask the right questions as you structure your investment strategy. In the next section, we'll dive deeper into what's driving the rise in passive investing and whether we're heading into a bubble. We'll also look at how to properly manage risk and why diversification is more important than ever. As we continue to explore passive investing, let's take a closer look at why these index funds and ETFs have become the go-to for millions of investors. The rise of passive investing, particularly in index funds and ETFs, has been nothing short of spectacular. Over the last decade, trillions of dollars have flowed into these funds, driven by a combination of low fees, simplicity, and the appeal of diversification. In 2025, the total value of passively managed funds is expected to exceed $20 trillion globally, making it a massive segment of the investment world. But why has this been happening? Low fees and automation. Traditional mutual funds used to come with high management fees and required investors to rely on fund managers to select stocks. This was both costly and time-consuming. In contrast, index funds and ETFs track an index, meaning they don't require active stock picking. As a result, these funds are much cheaper for investors. Ease of access. Nowadays, anyone can invest in these funds with just a few clicks on an app or online brokerage. With robo-advisors automating everything from asset allocation to rebalancing, even novice investors can build a diversified portfolio without worrying about the intricacies of individual stock picking. Market growth and security. Over the past few decades, the stock market has experienced tremendous growth. Many investors see passive investing as a way to capture that growth without being subject to the risks of individual stock performance. This is especially attractive during periods of economic stability, when the market has generally gone up over time. Visual. Chart showing the inflow of funds into index ETFs versus active funds, with key years highlighted. Host. Here's the big question. Are we in a bubble? While the rise of passive investing has been a great success story for many, there are some important considerations. The massive flow of capital into index funds and ETFs could be driving up the stock market more than we realize. This might create a bubble where prices are inflated beyond what the fundamentals justify. Here's the logic. The more money that flows into index funds, the more demand there is for the stocks that are part of the index. S&P 500 companies, for example, receive massive investments every time an index fund is purchased, since these funds track the S&P 500. The result? A self-reinforcing cycle where stock prices go up, not necessarily because the companies are performing better, but because more people are investing in these funds. In short, the money itself is driving stock prices higher. But what happens if the flow of new capital slows down, or if investors start to pull money out of these funds? This could create downward pressure on stock prices, especially those that are top-heavy in the index. Essentially, concentration risk can turn into price instability when investor sentiment shifts. Visual. Animated graphic showing how a small group of companies dominate the S&P 500 and other major indices. Host. Let's take a closer look at one of the core risks in passive investing, concentration risk. As we mentioned before, the S&P 500 is market cap weighted, meaning the largest companies, those with the highest market values, make up the biggest portion of the index. And here's the thing. These top companies have been growing disproportionately in the past decade. For example, Apple, Microsoft, and Amazon now represent a massive chunk of the S&P 500's total value. As a result, these companies are getting a lot of the investment dollars that are flowing into the index. So, when more investors buy into an index fund tracking the S&P 500, they are buying more of these companies, whether or not they are undervalued or overvalued. This concentration can lead to problems when the performance of these companies starts to slow down or when they face significant challenges. If one of these dominant companies stumbles, it can drag down the entire index, even if other companies within the index are performing well. So, while diversification is one of the main selling points of index funds, in reality, if the top companies are underperforming, the entire fund might underperform too. Visual footage of the 2008 financial crisis, stock market charts plummeting, and major news headlines. The host explains the parallels between 2008 and potential future market risks. Host, let's take a moment to reflect on what we can learn from history, specifically the 2008 financial crisis. The 2008 crisis is often remembered for its devastating impact on real estate, but there are important lessons here about the dangers of market bubbles and the risks of over-reliance on certain assets. In 2008, we saw how a financial bubble can form when speculative investing and overconfidence lead to inflated prices, until the bubble bursts. Back then, the real estate market was booming, with investors believing that housing prices would always go up. But the reality was that the market was over-leveraged, people were borrowing more than they could afford, and banks were giving out risky loans. When housing prices began to fall, the entire system unraveled, and major financial institutions collapsed. So, what does this teach us about index funds in 2025? The 2008 crisis showed how a market can become overly reliant on certain sectors or assets, which then leads to a correction when prices are too high. In today's market, the concentration risk in index funds could create a similar scenario. Let's break it down. Overvaluation. Just like in 2008, an asset can become overvalued due to excessive demand. In the case of index funds, we could see overvaluation of the biggest stocks in the S&P 500, driven by a huge flow of capital into ETFs and index funds. Crowding. When too many investors are all buying into the same fund, it can create a crowded trade. In 2008, the housing market was crowded. Everyone wanted a piece of real estate. In 2025, the same could happen with large-cap stocks, driving up prices even if they're no longer backed by strong fundamentals. Liquidity problems. When everyone tries to sell at the same time, there may not be enough buyers to maintain prices. In 2008, this was a major issue, as markets froze and banks couldn't liquidate assets quickly enough. The same problem could occur with ETFs, especially in a market downturn. Visual. The host draws a diversified portfolio on a whiteboard, showing different asset classes like stocks, bonds, real estate, and commodities. Host, now that we've identified the potential risks, such as concentration and market distortion, let's talk about how to safeguard your portfolio. One of the best ways to reduce risk is to diversify your investments. Instead of putting all your money into one index fund, consider spreading your investments across different asset classes. Here's how you can do it. Stocks and bonds. While index funds offer great diversification, you can further diversify by considering both equities and fixed income assets. Look into government or corporate bonds without interest-based exposure as a stabilizer. Real assets. Real estate investments, either directly or through REITs, real estate investment trusts, can provide diversification by offering exposure to physical assets that typically perform differently than stocks. Commodities. Commodities like gold or silver can also be a hedge against inflation and market downturns, giving your portfolio a layer of protection when equities are underperforming. International exposure. Don't just stick with the US. If the US market goes through a correction, international markets might perform better. Consider global equity funds or emerging market funds to capture more diversification. Ultimately, the key to successful investing, especially in a year like 2025 where we might be looking at a correction, is to have a well-rounded portfolio that isn't overly exposed to any one asset class or sector. So, to wrap up this section, if you are relying solely on index funds for your long-term investment strategy, you may want to think about whether you're comfortable with the concentration risks. Diversifying into other asset classes and international markets can help reduce your exposure and protect your wealth. In the next section, we'll take a closer look at how to manage risks in the current market and how to create an investment plan that works, whether or not we're facing an index fund bubble. Outro screen with a subscribe button, a reminder to comment, and a preview for the next video.